If you're buying Bitcoin today, it's still early. I don't think it's too late. So if you have zero exposure to Bitcoin and you feel like you missed it, 95% of investors have zero Bitcoin exposure. So you're still way ahead if you're buying Bitcoin today. If you look at Bitcoin wallets, comparing it to the internet, we're back to 1996 levels. Internet went exponential from 1996. So it's still the earliest days. When I started on Wall Street in the 90s, that's also what I heard on Wall Street. I remember our economists and our bond heads of fixed income saying the US is on an unsustainable path for debt, and that was 35 years ago. So for the next 35 years, you're going to hear the same thing. The US is on an unsustainable path of debt, yet it's probably not going to make a difference.
Every generation sees a technology so disruptive it transforms everything, often before most people even realize it. In the 1990s, that breakthrough was the internet. Today, it's Bitcoin and the wider crypto ecosystem. According to Fundstrat's Tom Lee, we're still at a very early stage, not just in price, but in adoption, infrastructure, and overall potential. Back in 1996, only a tiny slice of the world was online. The internet was slow, costly, and complex. But behind the scenes, rapid growth was building. User adoption soared, developers created new protocols and platforms, and what once felt niche became essential for global commerce and communication. Amazon launched in 1994, Google in 1998, and by 2006, the internet had become indispensable. Similarly, despite Bitcoin being over a decade old, over 95% of investors still have no exposure. Wallet numbers, on-chain activity, and institutional infrastructure are growing, but we remain on the ground floor. Crypto today is still rough around the edges, clunky, misunderstood, and controversial, but for long-term visionaries who understand historical cycles, this is a crucial turning point. Tom Lee believes buying Bitcoin now isn't missing out, it's positioning ahead of the next wave of adoption, which could rival or surpass the internet boom in wealth creation. This isn't just about speculation, it's about revolutionizing money, trust, and global financial systems. Lee's bullish outlook extends beyond crypto. In a recent comprehensive interview, he also tackled key macroeconomic issues: a potential 20% market drop triggered by tariff shifts, recession fears, and the Fed's struggle with post-COVID inflation using outdated tools. While many panicked earlier this year, Lee remained steady, and with stocks bouncing back sharply, he believes the worst is behind us. He explains why the Fed may have misread tariff-driven inflation, why interest rates could drop sharply in 2026, and how that could boost both equities and crypto. When liquidity returns and real yields fall, risk assets like Bitcoin and Ethereum often soar. Digital assets are no longer fringe, they're central to the financial conversation. If you want insight on where markets are headed, how to position yourself, and whether crypto still holds big upside, Lee's interview is a must-watch.
What's your overall assessment of the market, where we are, and how do you anticipate the market in the second half and 2026?
Well, the stock market in 2025 faced a black swan because Tariff Liberation Day was a shock, and it created a downward spiral in stocks, falling 20% in the fastest pace, or one of the fastest pace in 100 years. There have only been 12 times in history that stocks fell a similar amount and a similar speed. And I think the mistake many people made was that shock turned people bearish. As you mentioned, we did think there would be a correction this year, but the reason I think we didn't turn bearish, even though this was a huge decline, is three things. One, we didn't expect President Trump to stick with the tariff terms. So even though in the beginning they claimed this was the deal and everyone had to take it, we thought they would eventually walk back those terms, which is what's happened. And in fact, what we've seen so far is the tariffs are much, much milder than many people thought at the start of the year. So we're actually in a better place. The second is many economists convinced you that there'd be a recession. Do you remember all these economists said a recession's guaranteed, and that's why everybody panicked and sold their stocks. But we don't necessarily listen to economists. We prefer to watch what the high yield market is doing. And the high yield market, while it showed some turbulence, actually moved in a way that said there might be a growth scare. So there's a difference between a growth scare and a recession. A growth scare just means everybody gets cautious, which is understandable. And the third reason we didn't turn bearish is that waterfall declines, like we saw, usually come back as a V-shaped recovery. And that was our argument, that this would be a V-shaped bounce. And in fact, we were pretty convinced of it because the VIX, which is a measure of volatility, jumped to 60. And if you look at the last 35 years, anytime the VIX has moved above 60, no matter what you think, you have to buy the stock market because that's pure terror. The market is so scared, they're not pricing anything, and that's why you have to buy that. And so stocks had a V-shaped bounce. And now that we're almost back to the old highs, I'm finding a lot of people are still bearish. Maybe in the audience, you guys are still bearish, thinking, I don't see why stocks came back, so I don't really want to buy the stock market now. But here's something to keep in mind. In 2025, we've already had a 20% decline. The chances of a 10% decline between now and year end is very low. It might even be statistically 0%. So maybe the stock market could trade sideways for a little bit, but the chances of us declining again are very low. The Fed is not cutting rates right now. And Fed Chair Powell said he's not cutting interest rates because he's expecting inflation to rise over the summer because of tariffs. That might kind of makes sense. I mean, I'd say if someone said that to me, I'd say I understand that prices should be going up because of tariffs. But that is not actually how monetary policy should be administered. The Fed is really supposed to overlook supply shocks. So if you have a supply shock, like a tax, and it causes a one-time rise in price, the central bank is not supposed to adjust monetary policy for that because the Fed is trying to control demand, meaning if there's so much demand for something that it causes prices to go up, they try to tighten monetary policy. But because of tariffs is more like a supply shock, the Fed should actually look through it. The bond market is starting to make that conclusion. On Wednesday's FOMC meeting, the bond market disagreed with the Fed. Interest rates actually went down in the last couple of days because they don't believe the Fed should be on hold. And that's also been our argument, that the Fed, if they're not cutting now, they have to do more cuts next year. Maybe more importantly, most people think stock rallies are only because the Fed is easing, adding liquidity. That's why in the April lows, people were saying the stock market couldn't rebound because the Fed wasn't going to add liquidity. But guess what? We had a V-shaped bounce anyways. And so it shows you the central bank isn't needed for stocks to rally. But next year, we think they're going to cut a lot, and that should support stocks. And as far as positioning goes, I don't think you really explained our view on sectors this year. At the start of this year, our top calls were industrials, financials, and tech. That was first, second, and third. Year to date, industrials, financials are outperforming the market. And tech is actually beginning to outperform. So that's really been our stance this year. But with the Fed cutting rates next year, I think that's going to be good for interest sensitive. So that should really support financials, and it should support small and mid caps.
Tom Lee explains that despite the panic earlier this year, the U.S. stock market has shown remarkable resilience. Challenges like tariff shocks, economic gloom, and fears of tightening haven't derailed the long-term upward trend. Lee believes we're now entering a window of opportunity where the worst might be behind us. Both equity and crypto markets stand to benefit from easing financial conditions, cooling inflation, and a Federal Reserve that is likely to pivot more aggressively in 2026. However, Lee's analysis goes beyond market cycles and monetary policy to address a deeper, recurring concern among investors: U.S. debt and the future of the dollar. While many warn that the deficit is too high, borrowing unsustainable, and America is nearing a tipping point, Lee points out these alarms have echoed through Wall Street for decades without triggering collapse. The U.S. economy remains the most liquid, innovative, and globally dominant system in the world. Lee's core message is straightforward. Fear over debt and deficit hasn't altered the fact that the U.S. still leads global capital markets, innovation, and corporate scale. Currently, 21 of the world's 25 largest companies are based in the U.S. Borrowing costs remain surprisingly low despite massive debt issuance, and the dollar continues to hold its position as the world's dominant reserve currency, not because the U.S. is perfect, but because no real alternative exists. Let's get back to the video.
How we should look at, understand the physical situation and any potential risk here.
When you read the newspaper or you hear financial commentators, a lot of people tell you the U.S. is in trouble because of the deficit, and the U.S. has unsustainable debt. And that's true because we know the path for the U.S. debt is unsustainable. But here's the thing. When I started on Wall Street in the 90s, that's also what I heard on Wall Street. I remember our economists and our bond heads of fixed income saying the U.S. is on an unsustainable path for debt, and that was 35 years ago. So for the next 35 years, you're going to hear the same thing. The U.S. is on an unsustainable path of debt, yet it's probably not going to make a difference. That's my opinion. But I do agree that we're in a very strange world because the U.S. prints money and they print a lot of dollars, and yet the borrowing cost is really low. It's very mysterious to me, but I don't think today's levels represent any sort of break point. And here's a really simple way to think of it. One, dollars is the reason people have used, own bonds, right, and used the U.S. economy. And dollars are mostly used for speculation. For every dollar of GDP activity that we have, the dollar is traded in oil, bonds, equities 400 times. So as long as the U.S. is the most liquid economy in the world, we're going to print a lot of dollars and interest rates are going to stay low. And the second is that as much as you hear stories that say the U.S. is losing its importance, so the rest of the world is becoming more dominant, and that's why the U.S. is in trouble. One, again, I've heard that story for 35 years. Everyone's told me the U.S. exceptionalism has been over, and it yet has never ended. If you look at the 25 largest companies in the world, 21 of the 25 largest are in America. So just because U.S. borrowing costs might change, is Germany going to suddenly be the place where the next Mag 7 comes? Just because borrowing costs change in the U.S., will Germany suddenly be the next Silicon Valley? I mean, if you believe that, then you should bet against the U.S. I'm very skeptical of that. So I think you shouldn't make a portfolio decision thinking stocks are going to fall because someone told you the U.S. can't fund its deficit.
You did mention that you were one of the first on Wall Street to make a call on Bitcoin, but do you agree that Bitcoin, Ethereum, these cryptocurrencies will continue to do very well for the next couple of years?
Yeah, I mean, I think Bitcoin is, if you're buying Bitcoin today, it's still early. I don't think it's too late. So if you have zero exposure to Bitcoin and you feel like you missed it, 95% of investors have zero Bitcoin exposure. So you're still way ahead if you're buying Bitcoin today. If you look at Bitcoin wallets, comparing it to the internet, we're back to 1996 levels. Internet went exponential from 1996. So it's still the earliest days. I think Bitcoin is very useful because in the future, we're not going to be able to trust anything because cybersecurity, there's nothing secure anymore. We can sample your voice. I mean, even someone takes our voice, translates into Korean using my voice, you'll never know what's true anymore. So you need to be able to trust a system. The blockchain, the Bitcoin blockchain is the most trusted blockchain. And that's why the United States wants to have 1 million Bitcoin. US companies are buying Bitcoin. Banks will soon carry Bitcoin as collateral. But Ethereum is really important too. Did any of you buy the Circle IPO or own Circle? Circle is a stablecoin, and they just went public 10 days ago at $31. It's now $242.
What is the ticker code?
CRCL.
CLCL.
Circle is a stablecoin. It's the second largest. Stablecoins are being pushed by the United States government. Here's the thing. Circle runs on Ethereum. Stablecoins run on Ethereum. So as stablecoins explode, Ethereum is the backbone for stablecoins. So I think Ethereum is going to make a big comeback as well. So I think those two are useful. And then Solana I like, but it's not nearly as used as Ethereum.
Tom Lee's view on U.S. debt stands out because he doesn't deny the numbers but understands the broader system. He admits the debt is high and growing, and that the current path is unsustainable. However, Lee highlights that concerns about deficits have been around for decades. Since he started on Wall Street in the 1990s, economists have warned about U.S. debt. Yet despite this, the dollar remains dominant, interest rates stay relatively low, and American corporate power continues to lead globally. He believes that liquidity, institutional trust, and innovation, not just debt levels, will shape global leadership, and that betting against the U.S. economy is historically a losing proposition because it keeps adapting and producing dominant companies. In contrast, Lynn Alden offers a more cautious and structural perspective in her essay, Nothing Stops This Train. While she also recognizes America's resilience, Alden warns that no fiat system can sustain unchecked monetary expansion indefinitely. She sees the U.S. in the late stages of a long-term debt cycle, where obligations like interest payments and entitlements exceed tax revenues over time. Alden argues that the Federal Reserve is increasingly trapped. To avoid insolvency or social unrest, it must either monetize debt directly or suppress interest rates artificially. This approach, however, risks persistent inflation, declining real yields, and eroding faith in fiat currency. As she puts it, the train keeps moving, but the rails are bending. Nothing stops this train, but eventually it derails. Despite their differences, both Lee and Alden agree on one thing: the critical role of Bitcoin and crypto in the future financial landscape. For Alden, Bitcoin is an exit ramp, a neutral, scarce monetary asset outside government control, representing a bet against central bank credibility. Lee sees Bitcoin as vital not because of a U.S. collapse, but because the world is moving toward digital trust layers, with blockchain as the foundation of tomorrow's infrastructure. Both view crypto as more than a fad, it's a necessity. Lee also highlights Ethereum's role powering stablecoins like USDC, which function as payment rails and programmable dollars. Whether you side with Lee's optimism or Alden's caution, the message is clear. The future of money is being built now, and crypto is at its core. So, whose outlook do you align with? Tom Lee's pragmatic optimism or Lynn Alden's structural realism? For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.